It's my pleasure to be joined today by Jason Orthman, Lead Portfolio Manager and Deputy Chief Investment Officer for Hyperion Asset Management. Hyperion manages over $10 billion and has an exceptional track record of performance since establishment in 2002, roughly doubling the return of the market over a 19-year period. Recently, Hyperion Global Growth Fund is listed on the ASX via an ETF under the ticker HYGG, building on an already terrific 7-year growth path on that fund. Jason, thanks for joining us today.
Happy to be here, Tim.
Jason, Hyperion's known today for its global growth investing, but your roots are very much in the ASX, in the small to mid-cap market. I was wondering if you could share with us some of the big wins early in Hyperion and say how that shaped the way Hyperion invests today.
Yeah, sure. So I guess there's a couple of highlights there. Investing in REA Group early on in 2004, and so that's been a 200 bagger for us over that journey. And Domino's around 2010's probably been a 20 bagger. So, I mean, you're right, like our pedigree is in that compounding of small to mid-cap names. But, I mean, there's a lot of learnings you can take from that. Firstly, if you can actually compound capital at a high rate successfully, you can focus on that as an organisation. You don't actually need to be a marketing or product-driven organisation. And so that sort of $10.5 billion of FUM that you mentioned, 1.6 billion's been from clients. And the other 85%'s been from compounding returns. So we're pretty proud of that. And then it's about getting inflection points too. So both of those businesses, REA Group and Domino's, the businesses move from a stage where they're speculative to investment grade. And if you can actually identify the proven dominant market leader, the proven underlying economics, and you can get in at the bottom of that S-curve, you can actually compound wealth at really high rates. And clearly on a couple of those names that we've just mentioned, something like REA Group, it really showed up the importance of a network effect. And so Hyperion were really early realising it's not just an online portal or a website. There's, buyers and sellers and they feed on each other. And that really framed our thinking. And something like Domino's as well, the importance of scale, the importance of investing in your product, and the importance of actually using technology well. And if you go back a number of years, a lot of well-renowned investors and business people would say things like, oh, you don't need to worry about technology, that's on the edges. But, one of our structural themes is technology's moved from, the edges of society and businesses to the core. So, there's a whole range of learnings by, getting some of those compounding names right, giving you a bit of confidence in what you're doing, but take some learnings from it too.
And what are some of the filters or processes that Hyperion uses to pick stocks? I mean, you've got quite a diverse portfolio across a range of sectors, but there must be something specific there that you're looking for in all of them. And you mentioned compounding a few times there. Yeah. Where would you put compounding on the list of most important things to look for?
Yeah, compounding is really important, and I think that's why most people are in investing, and particularly in equities. You want to grow and compound that wealth over time at high rates. And so when we think about it, I think a lot of people assume that you only need to get 2 or 3 big things right. But when we operate in the tails, and we really want those winner-take-all type businesses that can compound at high rates, you have to get everything right. Yeah. And so, we have a qualitative research template, a common financial model, common valuation methodology, common portfolio management, and we feed all those businesses into it. And so I guess with those 2 disclaimers, like some of the key things we're looking for is clearly you want large addressable markets because you want a long runway, multi-decades to compound. You obviously need a business model that allows compounding, so that's capital light, high return on capital. And then the qualitative features are important, like what is the value proposition, how strong is the competitive advantage, because you do need some resilience, some persistence in that compounding. And then you need the management team to be strong. They need to think about it 24/7. I mean, we can't do it for them. Like we want them to nurture these businesses. And then clearly you obviously need an attractive valuation as well. So, we want it all. And we say no a lot. But we think we've got a framework to try and get those tail events.
And you do hold stocks for a long period of time, certainly probably longer than the average investor in the market. How many years out are you thinking when you're basing your analysis on these companies?
Yeah, we're looking at 10, 20 years. So look, if we're setting our intrinsic values in 10 years' time and putting a terminal value on that, you're obviously looking out further. So our holding period or duration's actually been 10 years, but we've held a number of businesses, particularly domestically for 20 years. And if you can get those few businesses and hold them for that long period of time, that's when you get that exponential growth. So 10, 20 years is what we're looking for.
I want to ask you a question about conviction, which is something Hyperion's known for. I've heard you say before that volatility is not a risk, which I think is a great statement, but it certainly does have the ability to shake even the most solid, steadfast investors and make them sell at pretty much exactly the wrong time. How do you remain so calm and retain your conviction in these positions when short-term news flow can really cloud the picture or share prices are moving wildly?
Yeah, so I guess there's a few aspects there. Like, firstly, you've got to understand nothing's linear in life or investing, and I think people often think, you start at the bottom of a curve and move, up to the right in a nice smooth journey, but investing's not like that, and I think a lot of people can't take any pain anymore, any short-term pain. So you do need to step back and understand that, and realise at times you're going to have to fight, and not everything goes your way. But once you've got that premise, you actually need a structure to protect you, because to your point, there's all these false narratives that you're fighting against, whether that's in the media, whether that's in short reports. And the amount of times people have tried to shake out Hyperion from their positions it happens a lot.
Unsuccessfully as well.
Yeah,
a couple of times.
Yeah, that's right. And it's because we go back to that structure and that framework, again, that qualitative research template, that common financial model, that common valuation, the common economic framework. And you need to be humble as well and recheck. So when we do have some negative news, you reopen the file, check all your qualitative work. But if there's nothing changed in our thesis, then we will try and take advantage of it. And so we call it non-fundamental share price moves. So if nothing's changed in any of those features that we can identify, in our world, the share price is moving for non-fundamental reasons, and we can take advantage of that and trim or add to your positions. But to your point, it's really hard to do if you don't have some sort of structure, or some sort of North Star, I guess, to go back to.
To block out the noise.
Yeah, 100%.
If we could just move to the current market, one of the big talking points at the moment is the potential return of inflation and what that will do to future interest rates. And it is moving, creating volatility in some of the parts of the market at the moment. I'm interested in Hyperion's view on this big issue.
Yeah, well, there's certainly, as you pointed out, a lot of momentum in the trade from structural growth names to value or cyclicals. And your question's right, is whether this is short term or long term. And our view is what's happening with the rising interest rates and inflation is actually temporary. But what we do again is we go back to first principles. So some of the things that are driving the inflation is obviously with the world opening up and supply chains restarting, you're going to expect input pressures. But we go back and think about, well, what are the macro headwinds? And when you think about technology again, that is deflationary at its core. If you get intelligent automation, that devalues human capital and human labour, and that puts downward pressure on wages. And the same thing applies with energy, which is a large component of that, whether it's oil, gas, fossil fuels. Like, the incremental cost of renewables is basically zero. So they're really deflationary. And then on the demand side, the consumer's been hollowed out for a long time. And pre-GFC, you really needed a strong base and a strong consumer to create that demand. And we all know about what's happening with inequality, and we don't see that changing, unfortunately. So when we look at the long-term frameworks, we do think inflation will be transitory. And then it's really about, well, what about valuations? Like, are we paying too much? And that's when you start thinking about the 10-year US bond yields. And when you look from the GFC to pre-COVID over 12 years, the 10-year US bond yield ran at about 235 basis points. Today it's sitting, as you know, a bit under 160. And we really struggle to see how it can go through 250 basis points over the next decade for a sustained period. Because when we look forward, we think the next 10 years are going to be harder than the 10 years that we had. Obviously, once you get through this reopening trade and you come back to the same grind, the same low growth, the same competition, the same disruption, the same modernisation, that you've just got much higher debt levels. So we keep revisiting our thesis again, but nothing structurally changed. And if you're actually selling really high quality businesses the future to buy some of these businesses whose intrinsic value is going down, by definition, it has to be temporary. At some stage it will end. You can't compound wealth without rising intrinsic values. And so at the moment, we're pretty comfortable with what's happening.
I've heard it referred to as like a melting ice cube, some of these value situations. But one feature, you mentioned debt a couple of times there. Debt is a low debt companies it's a priority for Hyperion. Do you just want to talk about why that's a case and your thoughts on debt in businesses?
Yeah, well, internally we have a thing called protect and grow, and we touched on it briefly with inflection point. So before you get the right to compound at high rates, you need to protect yourself and investors. And one of those ways is through having strong balance sheets, and it just takes out a risk, takes out fragility from your investment if you've got net cash on the balance sheet. And we really prefer our businesses to have net cash on the balance sheet because you can control your own destiny, and particularly through a crisis. And so that's why that's a core focus. And it all comes down to that fundamental business risk. We want low fundamental business risk, which, as you touched on before, is different to volatility because we can take advantage of share price moves. That's fine, but we cannot have a situation where you permanently lose capital or your intrinsic value comes down permanently because you've had these long permanent earnings downgrades.
If we could move to the current portfolio, I thought I'd ask about, you have got some holdings in your portfolios which polarise investors. You've publicly talked about your positions in Tesla and Afterpay, which are probably two of the more polarising stocks which have done exceptionally well, yet everyone seems to have a view on them, whether they should or shouldn't. Do you have a different process when you're dealing with a company where it can move wildly on short-term news flow or it can get overhyped or oversold? And how do you approach stocks when everyone has a view on it and everyone's looking at it?
Yeah, I think it's from the background that we come at it from. So we act as business analysts, long-term holders, and we do deep fundamental research for a long period of time. So before we entered both of those positions, we analysed those businesses for 3 to 5 years, and we identified what we thought was moving from speculative investments to effectively investment grade. So when it enters a portfolio, it may look sudden, but there's a lot of background to those investments, and and everyone does. Like, the future's uncertain, and you're really trying to pick the next blue chips, and that's when you can add a lot of value. And when we go back and when we purchased, REA, that was controversial because people said it was a website, or Domino's, a low quality pizza operator, or or Amazon that would never make a profit, or even things like Facebook. And it's only obvious in hindsight. So we try and step back and go, well, is this structural? Is there something permanent going on? And for both of those businesses, we believe, like, Afterpay is leading in the buy now, pay later trend. Tesla's leading in electric vehicles. And the large incumbents are saying, well, these are permanent shifts because, you've got PayPal entering, buy now, pay later, Commonwealth Bank entering. On the auto side, you've got all the traditional incumbents investing real money in it. So we know that it's permanent. And then it's actually trying to understand what the next generation prefers as well. So, like, if you went back to the 80s and asked those in their 20s, what car would they want to drive, they'd probably say a BMW. And, you look forward now and look at the surveys of those in their 20s, what they want is a Tesla. And the same on the buy now, pay later space. If you speak to someone that's 20, they probably don't have a credit card, they probably don't have a credit rating, so they need some other way into the system. So it really is coming at it from that angle, again, looking at 10, 20 years. Is this a structural trend? Are the preferences going that way? Because that's the next generation. And rather than just trying to rent a stock or trade a stock, actually act like a long-term holder and think, okay, what can these earnings look like in 10, 20 years?
Might go back to the Global Growth Fund, which is just listed as an ETF. If you could just give investors a feel for how you're going to approach that fund. It currently seems to be focused on very large cap global companies. And I suppose as the inflows come in, how you're going to be approaching capital allocation.
Yeah, so like every time a dollar comes in, it's really day one effectively. And we have a portfolio management process where the higher the internal rate of return, and in a risk-adjusted sense, the higher the weight. And so we will allocate any incremental dollar into the best risk-adjusted positions in that portfolio.
That's based on the 10-year view?
That's based on, that forecast 10-year IRR, and then it's risk-adjusted and the weight's moved up or down, effectively in our confidence in achieving that internal rate of return. But you're right, at the moment, they are large market cap names, but the addressable markets are so large, and when you look at the next winners in our business, whether it's a Square or an Airbnb or even a Spotify, the actual penetrations are only 2-3%. So they're very early, despite being quite large, dominant businesses with good value propositions. They're still really early in that investment process. And again, we're looking at trying to identify, in a world that we don't think is going to grow sustainably once we get through this reopening trade, where can you get areas of growth? And in those areas of growth, we actually want the dominant market players. And that's what we continue to look for. And we think we've got 25 of the world's best businesses, or the next best businesses. And we will move those weights around as well. So we're not just going to have 4% weights across those 25 names. It might be 1%, it might be 10%. Again, depending on how the share prices have moved relative to each other. And we'll do our best to allocate that incremental dollar to the best risk-adjusted return.
Jason, it's been an absolute pleasure talking to you today. On behalf of the whole Morgans Network and all of our clients, we really appreciate your insights today and look forward to following you in the future. Thanks very much.
Thanks, Tim. Appreciate it.